Good morning, everyone, and welcome to today's webinar on the Canara Robeco Multi-Asset Allocation Fund. We're joined by Mr. Chirag Mehta, Head of Products and Digital Business at Canara Robeco AMC. With years of experience across investment strategy and digital innovation, he's here to break down why the multi-asset investing might be the answer to market volatility and uncertain times. So let's explore how equity, debt, gold, and silver come together in one compelling offer. Over to you, sir.
Thanks a lot. Thanks for having me on this platform, and very good morning to all the viewers. And thanks for giving your time to hearing us out about our new offering, which is the Canara Robeco Multi-Asset Allocation Fund.
So we'll make it a conversation today, sir. So I'm going to have a list of questions that we're going to ask you regarding the fund.
Sure.
So let's start off with what is the core philosophy behind the Canara Robeco Multi-Asset Allocation Fund, sir?
Sure. So the core philosophy, let me just take a step back before we talk about the product, about what's happening globally, in the markets, right? There are tariff wars being played at a global level. There are geopolitical tensions happening across the continents. Few days back, we also witnessed the same thing in India as well. So there's a lot of uncertainty, right, in terms of what's happening globally. Now, when there's so much of uncertainty at a global level, you just don't know which asset class will come out stronger out of this situation, right? It could be equities, it could be fixed income, it could be commodities, it could be any. So we thought it's an ideal time, to offer a solution which brings all the three asset classes into one particular product. So that was the whole genesis, about looking to launch this product. With this kind of a situation, we believe that it's going to be a new normal where we're going to be in a world where there is some kind of cold wars being played, tariff wars being played, and everyone wants to be more powerful these days. So keeping this in mind, we thought that the uncertainty around at least the shorter term cycles for asset class returns are concerned. There'll be some kind of a multiple asset allocation based approach, which will help the customers to get away from the confusion, right? I mean, if the dust were to settle right now, let's assume it globally and domestically as well, you can see a runaway rally in equities. If this kind of an uncertain situation continues, there could be a move towards a less riskier assets, and probably you may see some rally kind of happening in fixed income segment. Or if there is complete uncertainty, you just don't know which way the world would go, people start attracting towards commodities. So we thought it's a good time to bring an asset allocation based product which will take care of this investors situation or dilemma of which asset class to invest in right now. So that's the core philosophy about introducing this product at this point in time.
Right, sir. So if you could just explain to us, how does this fund actively allocate across the equity, debt, gold, and the silver ETF, sir?
Sure. So if you look at the offer document, mentions that the equity allocation will be somewhere in the range of 65 to 80%. Now, this is the gross equity exposure, right? The fund also has a enabling clause to use derivatives to hedge the equity exposure. So let's assume we are in a scenario where the fund manager has taken hypothetically about 70-75% gross exposure in the equities. Now, if there's some global event happening or domestic event happening, which makes him believe that the markets could be volatile or uncertain in the near term. So they will actively use derivatives to hedge the portfolio and bring down the net equity exposure to say maybe 30, 40, 50% based on the views on the market. So while the gross exposure in the equity will remain in the range of 65 to 80%, the net exposure could be significantly lower based on the views on the market. Now, why we're using derivatives? Because as we all know, buying and selling into the cash segment obviously it involves a lot of cost. It has a higher impact cost and can impact the returns at the portfolio level. So we thought that derivatives is the best way to hedge the portfolio and manage the market volatility to the portfolio that way. On the fixed income side, it is going to be again a very actively managed portfolio. So based on our views of our interest rates, the fund manager will actively manage the duration in the portfolio. So the fund manager is very bullish that the interest rates are going to be cut. He may take the duration right up to 7 years, 8 years, 10 years. Or if there is some kind of a bearishness in the market and they expect the interest rates may go high, the fund manager will not shy away from taking the duration to a year or probably even less than a year. Other thing that we're going to do in a fixed income portfolio is there's going to be zero credit calls in this portfolio, because we are very mindful of the fact that investors who are coming in this portfolio are looking for a less riskier product or product which gives them better risk optimized returns. So we are not going to take any unnecessary risk in the fixed income. So no credit calls will be taken in the fixed income portfolio. On the commodity side, which is gold and silver ETFs, we're going to look at some global factors, because what we have understood, while we were researching about this product, is that the commodities prices are largely driven by the global factors and not so much the domestic factors. So we have identified certain factors, which includes, the correlation between US interest rates and commodities movement and all. So we're going to look at that also very actively, and then decide what should be the allocation to gold and silver ETFs. So this is a product, where all the three elements, which is equity, debt, as well as commodities, will be actively managed. It's not like you've allocated something to equity, debt remains the core, and rest will be passively managed. No. In this product, it is Canara Robeco Multi-Asset Allocation Fund. All the three elements, equity, fixed income, and commodities, will be extremely actively managed.
Okay, sir. So actually, this answers my next question also of what makes an multi-asset allocation fund an all-season portfolio. So how does this fund manage volatility, sir, across different market cycles and economic scenarios?
So the answer lies in a very interesting, analysis we did, and the outcome of it. So we looked at multiple periods of bull cycles, bear cycles, and say sideways market. What we observed, that even if you look at say 2 or 3 bull cycles, for example, the returns pattern, is not the same every time. Just to give an example, we could be in a scenario. There was one bull market where the equities delivered say 90% returns, fixed income delivered 20% returns, and commodities delivered minus 20% returns. We looked at the subsequent bull cycle. Again, equities were very strong, 60-70%. Fixed income was stable, 8 to 10%. But next time, the commodities delivered almost say 30 to 40% positive returns. Similarly, is the case in the bear market cycles as well. Equities could be negative, fixed income could be stable, and commodities could be negative. Equity negative, fixed income stable, or commodities could be positive. What the beauty about this product is, all the three asset classes, which is equity, fixed income, and commodities, are uncorrelated to each other. So they don't move in the same direction. So that means the fund manager in any market cycle has at least 1 or 2 asset classes which will do better in the market. So if you're able to get your analysis right, and that probably whether it's a good time to invest in fixed income or whether it's a good time to invest in commodities, it can help manage the not only the volatility in the portfolio, but it can also deliver you consistent returns across the market cycles. So all the three asset classes in equity, fixed income, and commodities are uncorrelated. They move in different direction, and they have different return pattern in different market cycles.
Okay, sir. So what's the role of the equity strategy within the multi-asset allocation fund, sir, and how is the equity allocation dynamically adjusted for you also?
Sure. So when we look at equity allocation in Canara Robeco, multi-asset allocation fund, we're going to look at three factors. One is the macro or the fundamental factors to identify whether it's a broad-based rally, are the fundamentals strong, or just a purely a liquidity-driven rally. The other factor we're going to look at is the growth factors. Whether the trend that we're witnessing in the equity market is backed up by say corporate earnings. Because many times what we witness, if it's a, for example, liquidity-driven rally, it may not be supported by earnings as much. So we're going to also look at whether the growth factors are also supportive or not. And finally, we're also going to look at the valuation factors. Needless to say, obviously, markets are very expensive. It kind of makes us think twice to make allocation significantly higher in equities. But if the valuations are comfortable, compelling, supported by growth, obviously the allocation into equities will be higher. So it's not that we're just going to look at one factor based on which the equity allocation will decide. We're going to look at multiple factors. We spoke about fundamental and macro factors, growth factors, and valuation factors. And only if if it gives a positive signal and a high conviction call, that we'll be able to increase our allocation in equities. As far as the monitoring is concerned, it's going to be dynamic and ongoing. It's not that we're going to wait for a month end or a quarter and then decide whether we'll change the allocation equity. It's going to be very dynamic. So if there is an event which has occurred which completely changes the dynamic of equity investing, then we'll not shy away from making changes in the portfolio accordingly. So that's how dynamically we're going to manage the equity and the factors that we're going to consider for deciding in equity allocation.
And how does the fund approach the gold and silver allocation based on macroeconomic and global cues, sir?
So fixed income, like we discussed earlier, purely will be driven by our views on the interest rates. Because the only thing that we will do is active duration management. Like we mentioned, we're not going to take any credit calls in this portfolio. So there's been no concept of credit management in this portfolio. the returns largely in the fixed income segment will be driven through active duration management. So if we are very positive about the interest rates going down, we'll take the duration significantly higher in the portfolio. Or if we believe the interest rates are on the rise, then probably we'll keep it very low or very benign at about 1 year or less than 1 year as well. On the commodities side, we're going to look at some global factors. I mentioned US interest rates, the global supply. If there's a geopolitical tensions, central banks typically tend to hold up onto gold, etc., which leads to higher prices. So we look at all these global factors to decide, how the commodities allocation should be made in this particular fund.
Okay, sir. So the next question is, what sets this fund apart from other multi-asset funds that are already available in the market?
So three, four things. First, obviously, when we look at equity allocation, right, it's going to be multi-factor based allocation. Which it's not a single factor which will decide equity. All the three elements you spoke about, macro factors, earnings factor, and the valuation factor, very complementary to each other. And when you look at these factors, the call that we get on equity is a very high conviction call. Typically when you look at one factor, the chances of getting it wrong is also significantly high, and that's why we looked at the multiple factors, to decide on the equity allocation. We have an in-house dedicated macro analyst who really tracks global as well as domestic factors on a real-time basis. So this particular gentleman will help us deciding on the commodities allocation. And because like we discussed earlier in the show, the commodity prices are largely driven by what happens in the global markets and not so much in the domestic markets. So that yeah, so, tracking the global factors is more important as far as commodities allocation is concerned. Fixed income, obviously, we said that we're not going to take any credit call. We know because at Canara Robeco philosophy is that we also have to be mindful of the investors coming in the fund rather than just focusing on delivering top-notch returns. We have to keep a controlled volatility, a controlled risk environment in this particular fund. That's how. I'm so sorry. And that's how we're going to manage the fixed income allocation. The third point which I'd like to highlight to some of our investors and viewers who are watching this, I'm not sure if many people are aware that Canara Robeco is the second oldest AMC in the country. Some of our funds, date back to 1993. Our ELSS fund, our balance funds, and they were launched in 1993. That means they have more than 32 years of track record now. And in this last 32 years, we have seen enough of market cycles, business cycles, everything possibly market could have thrown us at. We have, taken it in our strides. And through this last 32 years, we have built very, very, very strong investment process and risk management process. At Canara Robeco, risk management is as equal and as important as investment management processes. So it's not just that, you throw the risk out of the window and just decide, how you want to invest. The risk is also a very strong component of how we manage the funds at Canara Robeco. So all these factors, very multi-factor based approach on equities, a dedicated macro analyst and looking at the global factors, helping us deciding the allocation on commodities, zero credit calls on fixed income and active duration, plus more than 30 years of track record of managing money in the Indian markets is something that we believe gives us an edge.
Yes, sir. So according to you, who is this fund most suitable for in terms of investor risk and investment horizons, sir?
So start with horizon first. We generally say at least investors should remain through the one cycle of asset seasonality, which is typically about 6 to 7 years. So let's assume the investment horizon that we're looking to spot is at least 5 year plus. Because we all know markets in the near term, have become very, very, very volatile in the way global markets as well as domestic markets are. The near term tends to be extremely volatile. So to smoothen out that volatility impact, we at least recommend investors to remain invested for 5 years at least. In terms of the risk profile, we believe people with either moderate or aggressive risk profile, should consider investing in this fund. It's going to be equity oriented, but like I said, the net equity user could be significantly lower. But anyone who is either moderate in terms of the risk profile, or is aggressive, can definitely look at making this fund a part of their own portfolio.
And how does the multi-asset allocation fund benefit from equity taxation despite its multi-asset nature, sir?
Sure. So, like we discussed, in Canara Robeco Equity Multi-Asset Allocation Fund, minimum investment in equities will be 65% and maximum will be 80%. So, as long as the fund is able to invest minimum or gross exposure in equities, say minimum 65%, it becomes eligible for taxation that of an equity fund. So, despite having fixed income and commodities as well, as a part of the portfolio, but since equity remains the dominant part of the portfolio, which is more than 65%, the fund will be eligible for taxation of that of an equity asset class based on the current taxation rules.
Finally, sir, can this fund serve as a core part of an investor's portfolio? And what would be an ideal allocation according to you, sir?
Definitely, I think this is like we discussed an all seasons portfolio, and gives a nice shield to your portfolio, right? So when you have an only equities portfolio and the markets are not doing so good, the kind of pain the investors go through, when you have say a product a multi-asset allocation fund, what it does is it protects the downside significantly compared to your single asset class based approach. So it does two things. While it gives a shield to the portfolio, it also gives you more time to hold to your other equity holdings. Because there's some part of your portfolio which is doing the job of protecting the downside. You'll say, "Achha, let me wait for some more time and equity should come back." Otherwise, in panic mode, people also sell their core equity holdings. Having this kind of a portfolio, having this kind of fund in your portfolio, at least also gives you the additional time, to hold on to it.
All right, sir. So that's my list of questions, and we really appreciate you taking our time. And thank you so much, Mr. Chirag Mehta, for this insightful session. Your perspectives on the Canara Robeco Multi-Asset Allocation Fund has truly helped us understand how a diversified approach can provide stability and long-term potential. So to everyone who attended, we hope you found the session informative and actionable. So keep learning, keep investing, and stay tuned for more sessions like these. Until next time, happy investing.
Thank you. Thank you, everyone.